Today, we're digging into an idea that sounds completely backwards, but might just be one of the most important things to understand about our economy. Why the simple act of saving your money could actually be a losing game. Okay, let's just jump right in with a pretty wild thought. What if the system isn't actually broken? What if the fact that your savings slowly lose value over time isn't some accident, but it's actually part of the design? A feature, not a bug, meant to keep the economic engine running. Let's really get into that. To get our heads around this, we have to talk about the folks in charge, the economy's guardians, if you will, central banks. And you know what? Their mission is actually pretty clear and out in the open. At their very core, central banks are all about one thing: managing stability. Think of them as the pilots flying a massive airplane. That's the economy. They're constantly making these little tweaks and adjustments, using some really powerful tools to try and keep the flight as smooth as possible. And their number one tool, the main lever they pull to steer this entire economic ship, well, it's the interest rate. All right, now this is where it gets really interesting, because this one tool works in two completely different ways. So if the economy is running way too hot, right? Inflation is high, boom, they raise interest rates. That makes borrowing money more expensive, so people and companies spend less, and things start to cool down. But on the flip side, if the economy is sluggish and weak, they do the exact opposite. They lower rates, making it super cheap to borrow. The goal? To get everyone spending and investing again, to kickstart some growth. And, this isn't a one-time thing. Central banks are always fiddling with the dials, always trying to find that sweet spot, that just right temperature for the economy. And all this pushing and pulling is what creates the economic cycles we all hear about. The good times, the booms, followed by the inevitable slowdowns and contractions. But here's the catch. This really powerful steering wheel, it has a huge limitation. It's kind of like a one-way street. See, the thing that most of us miss is that all these changes, raising rates, lowering rates, they only affect what's going to happen in the future. They're designed to manage how we'll all behave tomorrow. They can try to slow down prices from rising next year, but they have absolutely no power to undo the price hikes that already happened last year. And this quote just nails it, doesn't it? Central banks can hit the brakes to keep the car from speeding up, but they can't roll back the odometer. The distance already traveled, which is the inflation we've already seen, that's baked into the system forever. So, what in the world does this mean for you and me, the person trying to save a few bucks? Well, it means the system has this silent penalty for saving. Let me show you how that works. It always starts small. You hear about an inflation rate of, say, 2, maybe 3% a year. It really doesn't feel like a big deal, right? Your $100 bill still says $100 on it. But what it can buy just got a little bit smaller. In the short run, a currency that's losing a tiny piece of its value every year, it seems totally fine, totally stable. But the real danger, the silent killer here, is compounding. That little, almost invisible loss just stacks up year after year after year, and the effect is, well, it's devastating. Just look at this. This chart shows you exactly what happens to the buying power of $100 over 20 years, assuming about 3% inflation. After just 10 years, your $100 can only buy what $74 could before. Fast forward to 20 years, and you're down to $54. Nearly half of its value just gone. It evaporated into thin air just because you held on to it. So what this all means is that the system completely flips the old rules of money on their head. That traditional virtue of being patient and saving your money, it gets replaced by a totally new set of incentives. And this slide just lays it out so clearly. The old way of thinking rewarded patience, right? Hold on to your cash, save it in the bank. But in a world with built-in inflation, that's a recipe for slowly losing your money. The new game rewards what's called positioning. That means spending your money, or better yet, investing it in assets that go up in value. It even rewards borrowing money, taking on debt, because the real value of that debt gets eaten away by inflation over time too. This is the real reason you see things like houses and stocks often rise way faster than our paychecks. And there it is, the big takeaway. Inflation does not reward patience. It rewards positioning. The system is basically nudging you, pushing you to get your money out of a savings account and into the game. And this is so important to grasp. This is not a bug. It's not some accident or a mistake in the system. It is the simple mathematical result of an economy that is designed for constant expansion. To keep that engine growing, the system has to, by definition, penalize anyone who's just hoarding cash and reward those who put it to work. So that leaves us with a pretty big question, doesn't it? If the whole system is built to reward positioning your money, not just patiently saving it, what does being smart with your money or prudent saving even mean today? That's the crucial question we should all be thinking about.